Hello, everybody. Good morning, dear ladies and gentlemen, dear friends. It is a great pleasure for me opening the second day of the EBI Global Annual Conference this morning. I extend our gratitude to Goethe University for hosting our event once again, Professor Wieland and Professor Troger for their help to make this happen. A special acknowledgement is due to Claudia Collins, to Ricarda Coll, for their exceptional support in orchestrating this event. The European Banking Institute was founded 8 years ago with a dual purpose: the establishment of a coordinated and structured approach to research in European banking regulation, and to facilitate a meaningful dialogue between university, regulatory bodies, and the banking industry, enhancing our collective understanding and crafting effective solutions for Europe. Today, EBI proudly encompasses 35 academic members across 23 European countries, each with a specialized and recognized focus on banking regulation and supervision. Under the guidance of Thomas Stetten, our president, the academic leadership of Christoph Gostros, Marco Lamandini, Benedict Clark, and Georg Ringer, and the fantastic support of Pascal Di Prima, Jakub Gren, and Nils Moll, EBI has achieved significant milestones. The publication of over 160 research papers within the EBI Working Paper Series, the launch of the EBI book series in collaboration with Pelgrave Macmillan, the development of a comprehensive database of EU cases in banking and financial regulation. I need to thank René Smith and Federico Dalla Negra for this. A weekly dissemination of EBI regulatory report. And for this, I need to thank Christos Kostos, which detailed the economic policy and financial regulation measures in Europe and update all week. We had the establishment of the EBI Masters programs, including LLM at the Frankfurt School of Finance and Management, and the Master in Law and Practice of the Banking Union at the University of Bologna, plus a very successful international summer school, which was designed and launched by Antonella Sciarrone years ago. And then I like to remember the creation of the Associate Researcher Group and the Young Researcher Group, which foster interdisciplinary collaboration and learning. Overall, we have more than 150 experts in the field of banking and financial regulation collaborating with EBI. The academic standing of the Institute had various recognition at the institutional level, and I'd like to mention one of them in particular, which involved the ESAs. We were honored to be selected by EBA, ESMA, and the EIOPA as one of their academic partners under the University Partnership Program. It is our intention to have with them a long-term and intense collaboration, which we expect will benefit our academic members and the research output. Even if these are remarkable achievements by themselves, our project is in constant evolution, and it is benefiting from suggestions and ideas from our academic, institutional, and supporting members. The unique aspect of EBI is the robust support from the banking industry and both private and public institutions. I'd like to acknowledge the essential contribution from our supporting institutional members who have supported EBI also financially and continue to do so, allowing the development of our academic project. And I'd like to thank the European Banking Federation, the European Saving and Retail Banking Group, the Association of German Banks, the German Saving Banks Association, the Hellenic Bank Association, the Italian Banking Association, the Spanish Confederation of Saving Banks, the Romanian Banking Association, the Dutch Banking Association, and the Swedish Saving Bank Association, plus the law firm Cleary Gottlieb, and our institutional member, the State of Essen. Our advisory board includes senior representatives from national supervisors and European public institutions. They've been instrumental in enriching our academic activities with their expertise. And together with the representatives from our supporting institutional member, we have the pleasure to be advised and guided by representatives from ECB, SRB, EBA, ESMA, ECA, BaFin, Banca d'Italia, Banco de España, the Dutch Central Bank, and the Portuguese Central Bank. This synergy is what transforms a well-crafted research into solutions with real-world efficacy. Many thanks for your attention. Sorry for this list of names, but I needed to thank all of them. And I leave the stage to Michael Engelhard from the German Saving Bank Association and one of our esteemed members of the advisory board for his introductory speech. Thank you.
So thank you very much, Enrico, and good morning to everybody. I'm very glad and honored to have the possibility to address some words to you this morning. It won't be a speech, it will be some remarks. I don't want to take too much of your time because I'm very eager to follow the panels, which will come just after my short intervention. Preparing for the event and this morning, I recalled why did we decide some years ago, many years ago, to become supporting member of EBI. And it recalled me somehow of the European motto, united in diversity, somehow. And if I look at the panels and the interventions we heard, it shows the important diversity, the important input, and the importance of different opinions. And that's where I really want to thank and welcome the development of the composition of the panels, which is diverse. We had it yesterday. Perhaps some aspects could be put more into the focus, but I think it was the opinions reflected yesterday, and I would like to congratulate the organizers to have this, because it is not one-sided, it shows the diversity. And as mentioned, I'm representing the German Savings Bank Association, and you know our positions are not always in line with European institution thinkings and projects. But I would like to stress, and to come back to 3 points chosen by the organizers as topics. For sure, we had the Basel transposition yesterday. The game is over in the sense of the law is done, so we are waiting the final text. And now the real work starts for the banking industry, which we are representing. And that's a big piece to be done and fulfilled. In that case, and we heard that also yesterday in some panels, our main concern is complexity in regulation. We look at, in this conference, looking back to 10 years of banking union, we have had a huge load of new regulation, and it's getting more and more complex. Might be interesting from an academic side in some respects to look at different pieces from a very practical side, and I'm looking especially at small and medium-sized banks. It's really too much up to now. So we are now facing a new cycle in the European terms. So we'll have a new parliament, a new commission very soon. And our major call would be have a close look at the complexity of regulation. Otherwise, to be a bit, very clear, regulation can also be a danger and a risk at itself. Second point we had yesterday was CMDI. You know the German position about ADIS. I don't want to go into the details of the discussion, but my colleague from the private banks, Zetzsche, I think he pointed out quite well the reasons why we are so critical about CMDI and for sure what might come next. There, I think it is very important to keep in mind that Europe is diverse, also in the banking industry, and from structural point of views, and that should be kept in mind and respected in all activity done on a European level. That means look, and we had that from Mr. Ringel yesterday as a more provocative question, why not let everybody try and see what is best? I would say there are models in Europe which are working well, and why not look at those also? Not having a one-size-fits-all, a very streamlined approach, but look left and right and see what is working and respect what has been done in that way. Today we will have two very interesting topics also, digital finance and sustainable finance, which we would then say as transitional finance. Moreover, I'm very eager to follow these two panels, very interested in your opinions and the statements there. For the banking industry, both parts are of extreme importance. Digital finance, day-to-day business, sustainable finance coming more and more into our work and also into the risk management. So very happy to hear that. I'm glad that we could meet here again after 4 years. In person, the exchange is extremely valuable, and I'm looking forward to the next conferences. I now have the pleasure to announce the first panel of today, and I would give the floor to the moderator, Professor Annunziata, also member of the academic board of EBI and coming from Università Bocconi in Milano. Very happy to hear you. Thank you.
And welcome back. Today, I invite my panelists to come and take their place. So, as anticipated, this morning we have the first panel on digital finance. Well, naturally, I would like, first of all, to thank the EBI, its chairman, its secretary, and all the colleagues for setting up, again, this great annual conference. It's a pleasure, obviously, to be here again and to see many friends and colleagues in person. And the conference comes again at a sort of a pivotal point in the development of European banking legislation. It's sort of here to take a picture of what happened after 10 years from 2014. A lot has happened, but a lot is still going on. So it's sort of like a film, a moving target that is constantly changing. And one of the most innovative areas, intellectually, but also from a practical perspective, very stimulating, is naturally digital finance, where we have this huge work sites going on. Some of them have just reached the first conclusions, such as we heard yesterday, the MiCA regulation. Others are still open. So it's quite interesting, and also it's a deep honor to have the panelists today. A very short presentation. These people need no presentation, actually, but it's just sufficient to say that. As for Rosa Lastra, who is joining remotely, hello, Rosa. I hope you can hear us and see us as well. She's a member of the academic board of EBI, and she has a strikingly long career and experience in lots of international institutions, even though her core activity is at Queen Mary University of London. And then we have the pleasure of having Despina Schatzimanoli from the European Banking Authority. Despina is one of the people who have been most closely following the MiCA regulation, amongst other items connected with digital finance. Naturally, she's not just a super expert in MiCA and digital finance, she's a super expert in general in banking regulation and supervision. So it's really, thank you very much, Despina, for being here. And then Antonella, Sciarrone, Alibrandi, as well, a member of the academic board from the University Cattolica of Milan, but amongst other things, very recently appointed as member of the Italian Constitutional Court. So we have the deep honor and pleasure of having, sitting just next to me, a member of the highest jurisdiction that we have in Italy, the Constitutional Court. And thank you, Antonella, for being here. We know how busy you are, but really it's a great honor. And then Dirk Zetzsche, again, he needs no presentation, another member of the academic board and ADIA chair in the University of Luxembourg, and a tremendously long curriculum that it would be sort of pointless to recount, otherwise I would eat up all the time I have in the panel. Just one last remark. This is a quite unbalanced gender panel because we have more women than men. And especially in if you count the speakers, we have 3 out of 4. So Dirk, you'll have a hard time to, to handle these 3 ladies, but it's up to you. I'm just here to moderate, and I will just intervene if things get rough, and I have to calm down the audience. But in the meantime, Rosa, thank you for joining us. The floor is yours, and Rosa Lastra will focus on digital currencies and CBDCs, not just the digital euro, but more in general. Thank you very much.
My presentation is divided into 3 parts. First, I will briefly discuss aspects of monetary law and theory only insofar as they relate to the development of digital money. Because while unbacked cryptocurrencies, tokenized deposits and stablecoins are examples of private digital money, CBDCs are or will be a manifestation of the power of the state in the issuance of money, fiat money or public digital money. Secondly, I will talk briefly about the digital euro proposals, and then I will talk about the international dimension, including comparative proposals as well as the international role of the euro. Money is or becomes a public good. This means that the public authorities should have a role both in the potential issuance of public digital money or CBDCs and as ultimate guarantors in the regulation and supervision of private digital money and the payment systems associated with it. The Silicon Valley Bank crisis and the subsequent saga of banking troubles in 2023 evidence that there are actually very few libertarians in a financial foxhole, as an FT commentator put it. Charles Goodhart explains in his book, The Evolution of Central Banks, how competing banks in the 19th century had a natural tendency to centralize reserves, and how this competition and centralization of reserves led to the emergence of a central bank as a non-competitive, non-profit maximizing institution. And I put it to you, and some authors have also put it to us, that in the fintech universe, we can already observe a gravitation towards the center in the concept of stable coins, which after all gravitate around fiat currency and safe assets for the most part. The legal frameworks of money and central banking around the world were drafted well before the digital revolution. So central bank laws so far have spoken about coins bound notes and reserves, but not digital currencies, tokens, or ledger system. That's why the legal basis for digital money becomes such an important issue. In a contribution that I wrote with Jason Allen on Lex Cryptographia Financiera, we confront some of these issues, and we link the idea of code as law, borrowing from Lessig's seminal contribution and the concept of embedded norms, with the medieval lex mercatoria, which, as you all know, is the non-state legal system that evolved within trading networks across the complex, fragmented political geography of Europe in the Middle Ages. The current rise of RegTech, supervisory technology, subtech, legal technology, legal tech, and the possibilities of AI shows that the possibility of encoding legal norms into the technical layer of social technical structure is promising. Monetary theory, when it comes to digital money, is at times trapped in a dichotomy between the state theory of money and the market theory of money. And digitalization adds a new dimension to this dichotomy. The societal theories of money, anchored in Savigny and influenced by a number of scholars, including Nussbaum and in modern days Morgan Riggs and many others, argue that it is not the state, but ultimately society and custom that decided what money is. And there is certainly a complex interplay between politics, law, market, and now technology in the creation of money. The commodity theory of money, often metalist, stressing the importance of minting of coins, contrasts with the credit theory of money, which stresses the credit-debit relations and the social constitution of money. But both theories are influencing developments in the digital world, in digital money. Central banks, as we know, were skeptical of virtual currencies or digital currencies, and sometimes the terminology keeps on changing. The anti-money laundering directives keep on talking about virtual currencies. We have moved a lot into digital currencies. Anyway, they were skeptical until Libra arrived. Central banks had watched the arrival of Bitcoin as a niche experiment for exoteric libertarian techno-aficionados in California, or worse, for people engaged in money laundering around the world, but they didn't feel threatened. However, the announcement by Meta, Facebook, with its 2.9 billion users of a digital currency, private Libra, which then became Diem and was ultimately discarded in 2022, was a turning point. Central banks, which were reluctantly dragged into the digital provision of money, started experiencing what some refer to as FOMO, fear of missing out, like teenagers. And digitalization has indeed reached the source of central banking. China and Sweden went first with their proposals, and again, around 90 countries are exploring or have introduced already CBDCs according to the Atlantic Council Central Bank Digital Currency Tracker. However, I noticed as of lately, there has been somehow a cooling effect. And we have somehow moved a bit the debate, at least in some jurisdictions, from when to if. But I put it to you that preparedness in any case helps both with the when and the if. So we move now into the second part of my presentation, which talks about the digital euro, something which everyone in this distinguished audience and panel is very familiar with. The ECB published in October 2020 a report on the digital euro. The European Commission on the 28th of June unveiled a single currency package, setting out a framework for the introduction of a digital euro as a complement to physical cash. This package, as we all know, comprises inter alia, and most importantly, a proposal for a regulation on the establishment of the digital euro on the basis of Article 133 of the treaty, which reads that without prejudice to the powers of the ECB, the European Parliament and the Council, acting in accordance with the ordinary legislative procedures, shall lay down the measures necessary for the use of the euro as a single currency, and such measures shall be adopted after consultation of the European Central Bank. So it was this provision and not 128 that was chosen, as well as a proposal for a regulation of the legal tender of euro bank notes and coins, also based on the same provision. And then a proposal for a regulation on the provision of digital euro services by payment system services providers incorporated in member states whose currency is not the euro, based on Article 114, which, as we know, is the provision for the advancement of the functioning of the single market. On the 31st of October 2023, the ECB issued an opinion on the digital euro, where it emphasizes that the proposed regulations must respect the principle of central bank independence and other treaty provisions, and a few other important issues. And then, after a 2-year investigation phase, the ECB Governing Council decided to proceed to the preparation phase, starting on November 23rd, which will comprise 2 stages, the first for 2 years, and then based on the results of the first stage, the Governing Council will then decide whether to move to a second stage and define its scope and duration. And as stated in the ECB website, and also anticipated to some extent in the opinion, the preparation phase would allow extensive analysis, testing, experimentation, stakeholder consultation to ensure that the digital euro meets the highest standards of quality, security, and usability. And it also points out that the start of the preparation phase is a significant step, but, and I emphasize the but, it does not preempt any decision by the Governing Council on the issuance of a digital euro. The decision can only be considered after the relevant legislation has been adopted. It's important to recall that the limits or contours of the legal concept of money delineate regulatory perimeters. For example, in 2018, the then president of the ECB, Mario Draghi, stated his position on the classification of virtual currencies. Estonian proposal for a CBDC, which would have been called Estcoin, had been deemed to be a proposal for a new form of money and therefore inconsistent with the treaty. And privately issued virtual currencies were dismissed as money candidates and were held to fall outside the oversight remit of the ECB. In consequence, regulation occurred at the national level, leading to a proliferation of different normative frameworks with the potential for undesirable regulatory arbitrage. However, the adoption on the 16th of May of the MiCA regulation, to which the Spina will be talking about, therefore I will say no more, established a harmonized regulatory framework and a common supervisory architecture to both issuers and providers of crypto asset services, with exceptions and not a complete framework, but I will let the Spina talk about it. Not issue is considered to be part of the exclusive competence of the Union in the area of monetary policy for the member states whose currency is the euro, according to Article 3(1) of the treaty and Article 128 of the FEU, which provides the legal basis for the ECB and the NCBs to issue a digital euro in the form of a digital equivalent and complement to tangible cash. Interestingly, the proposed regulation does not mention Article 17 of the Statute of the European System of Central Banks, which deals with accounts with the ECB and the NCBs. Account-based CBDCs could be provided on the basis of this article, while Article 128 provides a legal basis for token-based CBDCs. The idea of monetary anchor, the singleness of the euro, and the two-tier monetary system are both features and rationale of the proposed digital euro. Of course, we have to remember, when one talks about the two-tier monetary system, that digital private money, quote, quote, has been with us for some time, since bank deposits are accounted for and transferred these days using online systems. A digital euro, says the website, has said a number of speeches, would provide an anchor of stability for our money in the digital age. The question is this so? The proposed digital euro is a liability of the central bank. In a paper that I have written with Michael Kuhnhoff and other authors, we question really whether just central bank money should be a liability of the central bank or something different like social equity of the nation, but I will not go further into this point for lack of time. Going back to the proposed features of the digital euro, importantly, it is a retail CBDC, not wholesale. and it is a complement to notes and reserves. It will be issued by the central bank and available to everyone in the digital area as a digital form of cash, and it will not bear interest. Article 128, which I just mentioned, introduces the concept of legal tender, though it does not elaborate on its scope and legal effects. And the digital euro is to be granted legal tender status. Article 4 of the proposed regulation says that the legal tender status of Eurobank notes and coins shall entail their mandatory acceptance at full value with the power to discharge from a payment obligation. And Article 15 states that Eurobank notes and coins and the digital euro shall be convertible into each other in part. One of the controversial issues of the proposed regulation is that of holding limits. Article 6 of the proposed regulation introduces limits on the use of the digital euro as a store of value, including holding limits. The reason for doing this is financial stability, in line with Article 127.5 of the treaty, since it is feared that the unrestricted use of the digital euro could have adverse effect on credit provision to the economy by credit institutions. The fear of intermediation is present here, given that some banks have expressed the worry that too attractive a digital euro could lead savers to withdraw their money from bank deposits and store it in safer digital euro accounts backed by the central bank. The centralization trend that Charles Goodhart warned about is also here. If such a move happened too quickly, this could pose a risk to financial stability and the way that we provide credit in the euro area. And the potential unlimited access to central bank money could backfire in the case of a digital run. Moving from legal tender issues and the issue of holding limits to other issues of design, it is important to bear in mind that if commercial banks are faced with the central bank as a competitor providing retail CBDC, their business could decline and they could shift their focus towards the wholesale side. The digital euros outlined in the proposed regulation will be a retail CBDC, not wholesale, and by going for a retail CBDC, the EU takes a different path from other jurisdictions. The Swiss National Bank, for example, is interested in a wholesale CBDC, that could be used to facilitate interbank settlements. A fundamental issue, which I will not discuss further, is the interaction with the stable coins and the regulation of the new ecosystem. Perhaps after the Stina has talked during the Q&A, we could talk about this new ecosystem that comprises public and private forms of money in the future. I will not talk either about important issues of data privacy and prevention of financial crime, but those are clearly in every jurisdiction that is looking into CBDCs or has introduced CBDCs a key issue. And finally, there are concerns both about central bank independence and also the counterpart of central bank independence, which is excessive power in the hands of the central bank, and therefore the need for adequate measurements or mechanisms of accountability. With expanded mandates, we really need commensurate measures of accountability. Accountability, after all, legitimizes the existence and the operations of central banks as independent entities. In the third and last part of my presentation, I'll talk briefly about some of the international issues. First, the international role of the euro, because one of the rationale that could be seen as introducing digital euro is that it will be attractive on the international scene and increase potentially the international role of the euro. The euro remains the second most important currency after the US dollar, according to various indicators of international currency use, such as holding of foreign exchange reserves, international debt and loans, global payment currency, SWIFT, foreign exchange turnover, and others. The euro has indeed all the necessary preliminary settings to be an international currency. There are no restrictions on its purchase, sale, or holdings, and about 60 countries have chosen to use the euro as their own currency or to peg their currency to the euro. However, the euro tends to be more of a regional currency, given that it is used to a significant extent for cross-border transactions concentrated in the European continent, while the use of the US dollar for cross-border transactions and banking activities is global. The European Commission has repeatedly emphasized the importance of a strong international role for the euro in joint communications with the European Parliament, the Council, the Commission, and the ECB. Let me talk also very briefly about a global digital currency. There is no international authority with the ability to issue currency. John Maynard Keynes, in the proposals that led to the establishment of the IMF, proposed a bancor as a global currency. In the end, no new international unit of account was adopted in Bretton Woods, and instead the 1944 Bretton Woods Agreement stressed the importance of the US dollar as envisaged in the Articles of Agreement of the IMF. And though bancor was never established, in 1969 the IMF took a limited step towards establishing an international unit of account with the creation of the special drawing rights, which also addressed the need for international liquidity. The SDR, or special drawing right, was created as the principal reserve asset in the international monetary system. Over the years, several proposals to harden the SDR so that it could become a medium of exchange have been unsuccessful. Interestingly, the former managing director of the IMF, Madame Christine Lagarde, now president of the ECB, suggested during her tenure at the IMF that digital SDR could circulate along national or regional currencies. And Mark Carney, former governor of the Bank of England, in a speech in 2019, discussed the opportunity of establishing what he called a synthetic hegemonic currency, or SHC, a global digital currency anchored by a basket of fiat currencies, and wondered whether such a new global currency could best be provided by the public sector, not the private sector, perhaps through a network of central bank digital currencies. Mark Carney said that a synthetic hegemonic currency could dampen the influence of the US dollar, and that the US dollar and global financial conditions could also decline if an architecture around the new synthetic hegemonic currency would displace the global's dominance in credit markets, and also by reducing the influence of the US on the global financial markets. This would reduce the volatility of capital flows to emerging markets and could facilitate emerging markets' efforts to diversify their holdings of safe assets away from the US dollar. Just very briefly on the comparative approach, Filippo kindly said that I will be talking very briefly, I have little time left, about what is happening in other jurisdictions besides and beyond the euro area, or the European Union at large. In the US, in early 2022, the Federal Reserve System, which incidentally is a very reluctant and unconvinced and latecomer when it comes to CBDCs, published a report on the US dollar in the digital age. And in March 2022, US President Biden signed an executive order requiring the government to assess the risks and benefits of creating a new digital and decentralized financial framework. And then two stablecoin draft bills were published in 2023, one sponsored by the Democratic Party and the other sponsored by the Republicans. Ranking member Waters in the Democratic and Chairman McHenry in the Republican. But the US is very reluctant to adopt the digital dollar. The UK appears, like the EU, more positive towards the establishment of a digital pound. And the Bank of England and His Majesty Treasury announced in 2021 the creation of a task force to explore CBDCs. But then the House of Lords published a very skeptical report in 2022 entitled CBDCs, a solution in search of a problem ? But the debate continues, and in February 2023, HMT and the Bank of England published a digital pound consultation paper for the potential adoption of a digital pound, which was then accompanied by a technology working paper published by the Bank of England. And then the Financial Markets and Services Act of 2023, the last piece of legislation that incorporates the full effect of Brexit in the UK, and which received royal assent in June 2023, classifies crypto as a regulated financial activity and stable coins as a means of payment under existing laws, though it doesn't have the same regulatory apparatus as MiCA. But while the US is reluctant to adopt the digital dollar, and the UK and the EU appear more positive towards the establishment of a digital pound and a digital euro, some Japanese scholars think that the cautious optimism of the EU and the UK is a possible measure to compete with the hegemony of the US dollar by developing internationally attractive digital euros and digital pounds. Interestingly, the Japanese attitudes towards CBDCs is characterized by cautious optimism and a proactive stance towards research and development. On December 23, 2023, an expert committee on CBDC was established in the Ministry of Finance in Japan, and it issued a report which stated the following. Allow me just to read a paragraph. Although the objectives and significance of CBDCs in major countries and regions are different, they generally share the same goals of ensuring monetary sovereignty and monetary and financial stability, efficiency of the payment system, strengthening and streamlining domestic settlement, improving cross-border settlement, promoting financial inclusion through ensuring access to central bank money in the digital age. And then it continues and it says that in addition to monitoring what is happening in the Europe and the US, it's essential to keep abreast of trends in other countries, obviously Asian countries for Japan, particularly China, with which, and other countries in Asia, with which Japan has very close economic ties. So by way of conclusion, money is or becomes a public good, as I said at the beginning, and this requires the public ordering of the monetary and financial system. In that public ordering of the economy, where the safeguard of confidence is key, central banks have traditionally played a key role as lender of last resort, as monetary agent, and in the discharge of its responsibilities in the pursuit of the goals of monetary and safe and sound banking, in many jurisdictions, a strict mandate on financial stability. The digital euro CBDC, if created, will be fiat money, and all private digital money will need to be regulated. Allow me a final reflection, and that is that the tectonic plates of money and finance have started to move with the opportunities provided by the crypto space, DLT, and just digitalization in general. But there is a feature which I wanted to mention, which is the weaponization of money and payment through the imposition of sanctions, which is another subject for another panel. But from the perspective of monetary law and the international monetary dimension, it can lead to a multipolar and fragmented monetary payment systems. Indeed, since the imposition of sanctions on Russian central banks, non-Western countries have accelerated efforts to develop alternative digital payment systems less reliant on the US dollar, and not only in Russia. So the emergence of small region currency blocks based on trade between countries, China, Russia, China, Saudi Arabia, India, and a parallel monetary and payment system will eventually, or could eventually, in the future challenge the current monetary system based on the hegemonic role of the US dollar and also the monopoly of SWIFT. And also the less regulated crypto domain offers alternative methods and leakages through non-cooperative jurisdictions, since they can resort also to the global offshore banking network. And why do I make these reflections at the end? Because one of the things which is very important for the future of the digital euro, if adopted, and just the future of the CBDCs in other jurisdictions, when, if adopted, is the maintenance of the dual monetary system. And this is really a question mark in the light of all the challenges and all the tensions and all the various influences that are affecting the development of of money in the digital age. And with this, I return to the floor. I give thanks again to Filippo for chairing the panel, and also for, and allow me a tiny bit of marketing. We are putting together a book to be published by Oxford University Press on MiCA. Thank you very much, everyone, and I will now stop sharing my slides. Thanks.
Rosa, I really cannot find the words to thank you enough for your great presentation, we clearly see that we have these two worlds, public and private digital money, that are moving apparently on parallel levels, but they tend to cross. Technology is a common element, even if we do not know what will be the technology that will support eventually the digital euro, whether it will be distributed ledger or something different. But clearly technology is the common element, and your speech sort of builds a bridge very well to Despina's speech on MiCAR, and also Despina's speech builds a bridge to yesterday's panel, where we already discussed MiCAR, and actually the audience got very excited about MiCAR, and so it's very interesting to come back again and talk about MiCAR after your speech on public digital money. So Despina, the floor is yours, and we are very keen to hear your position on this very interesting and controversial MiCAR regulation. Thank you again. Thank you very much, Despina, for your speech, and especially for the focus you placed on the institutional impact of MiCAR, because when the whole discussion on crypto assets began, and I have to say that we are still deeply in debt with the FINMA position, because the taxonomy that we have in MiCAR was not invented in the EU, it was taken directly from the guidelines that FINMA issued 2018-17, the three areas, financial products, and then utility tokens and payment tokens. But nobody would have thought that this new regulation would have led us not only to change the way in which we see services provided on the market. I mean, technology has been changing the way in which financial services are offered for the past 40 years. It's nothing new. But what's new is that these technologies are changing the products that we have on the market, not just the way in which financial services are provided, the products that we have, the services that are being provided in themselves, not the way, but the nature of the services. And then there's this institutional impact that nobody would have thought about, where we see that the EBA is transforming itself into a sort of a multifunctional authority. And then if you put it all together, it's a fascinating topic for another seminar. If you put together the relics of Meroni, the impact of MiCAR changing the EBA and turning it into a quasi-supervisory authority, and the increasing role of soft law and the FPF decision of the Court of Justice, well, I don't have to add anything to that. It's just put three things together and you see how revolutionary the whole thing is. And then the second big topic in digital finance is artificial intelligence. And again, that's an area where we see the transformative impact of technologies in the way in which the services are being provided, will be provided, and artificial intelligence has naturally ramifications in lots of other areas of European law, including protection of fundamental principles, privacy, fundamental rights, and this second topic is in the hands of my dear friend and colleague Antonella Sciarrone, who will lead us through the recent developments in this area by conducting a difficult exercise. She will try and explore how the AI Act in particular relates to the financial sector, the AI Act, as we know, is a horizontal measure. It sort of refers to financial regulation because it has to do so, but it was not focused on financial regulation. And it is also a little bit, I don't want to be offensive, but I use the expression in a neutral way. It seems to be ignorant of what happened in the financial world before the discussion kicked off, because, for instance, many of the topics that were discussed during the preparatory phase of the AI Act, such as control over the algorithms, managing the risk-based approach, had already been discussed and regulated in the context of MiFID II, high-frequency trading and algo trading. Naturally, it's a specific world, but it's been a laboratory for testing algorithmic legislation, and it seems to have been a little bit forgotten in the debate, because these topics were sort of set on the table as being, oh, it's something entirely new. We have to find a way to control the risk associated with the use of algorithms, but you had this huge chunk of European financial legislation that 10 years before had already tried to solve the issue, and apparently it worked well, because in that part of MiFID, we didn't see any more flash crashes or things really going as bad as it was before. So, Antonella, thank you again. The floor is yours.
Thank you, Filippo and Christos, for the invitation. I agree with you, Filippo. This is a really interesting topic, also very challenging. Not also per se, because of course artificial intelligence is extremely relevant, is an overarching topic, and so it's dangerous, but artificial intelligence is able to bring new opportunities, and so the topic doesn't need comments. But in my mind, this topic is also extremely interesting because this is a sort of laboratory of a new, quite new regulatory strategy at the European level. The AI Act is the idea of the AI Act is a regulation, an overarching regulation, an holistic regulation, and not a specific sectorial regulation. But of course, as Filippo said, there are many, many relations between specific fields, specific markets. In the financial markets, many solutions had already adopted many years ago. And so it's quite interesting to verify if the strategy adopted by the European legislator in the field of AI is working, and which kind of problems of interplay between the general regulation and specific rules and specific markets is building. And so the assumption is that the European legislator is seeking to deploy a cross-sectoral approach to AI, and this is true both from an ex-ante regulatory perspective, because the AI Act adopts an ex-ante approach, but not only this general approach, we can find this general approach at the European level also with regard an ex-post liability perspective. And I'm referring to the two proposals of directive at the moment on the table. The proposal for the revision of the Product Liability Directive, so the General Product Liability Directive, related to these new products and services, and a new specific proposal for an AI-specific liability directive. And this second proposal is strictly connected with the AI Act. And my questions are, which are the implications of this general regulatory strategy in the sectoral domain of the financial system on one side? On the other side, which are the concrete regulatory techniques relevant to coordinate general AI-related regulations, and sectoral financial requirements. So, I will start with just a couple of points about the AI Act in general. In line with the European legislators' intentions, this AI Act is supposed to be a horizontal regulation, regulating AI models in every sector of the European internal market, and a risk-based regulation targeting the minimization of the risks arising from the manufacturing and employment of AI systems. However, exactly in this last respect, it is important to observe that the AI Act is not a truly holistic framework, because it doesn't address every type of AI models and of the risks that can potentially arise from these AI systems. And why? Because the risk-based approach, structuring the AI Act's provisions, is aimed at the protection only of European citizens' personal fundamental rights, in accordance with the principle of human centrism recalled under Recital 1 of the AI Act. And in accordance with this choice, in accordance with this approach, the majority of the AI use cases in the financial market fall outside the scope of this regulation, because they have not directly impact with personal fundamental rights. And in this perspective, we can say that at the European level, at the moment, there are two different strategies about AI. One strategy, a stronger strategy about AI, focused on the protection of personal fundamental rights. Another one, strategy, more market-driven, and the market-driven regulatory strategy is more present, of course, in our field, in financial field. And the two strategies coexist at the European level. So, in line with this approach, the direct application of the upcoming regulation to the realm of financial markets is narrow, the direct application. And it is narrow because only 3 AI systems, AI applications, are qualified as high-risk AI system. And the 3 are credit scoring systems and health and life insurance scoring. And of course, why these 3? Because only these 3 have direct impact on personal fundamental rights. And for these 3 artificial intelligence applications, the Recital 80 of the AI Act establishes a functional link between the general AI regulatory framework and sectoral regulation. And this is quite interesting in my mind, specifically for these 3, but in general as a laboratory of regulation, because the referral to sectoral financial regulation occurs in accordance with 3 different regulatory techniques recalled by the same Recital 80. Because the idea is that union legislation on financial services already includes internal governance and risk management rules and requirements. This is obvious, which are applicable to regulated financial institutions. And it's important to find a link between the already existing internal governance and risk management rules and the new requirements, quite heavy requirements for high-risk artificial intelligence applications in the financial field. And there are 3 techniques: equivalence clauses, derogation clauses, and integration clauses. I don't go into the details because I don't have enough time, but it's positive in my mind that the European legislator is trying to find the way to avoid overlapping, duplication, and to determine which rules are applicable, the general rules, the specific rules, a combination of the two. This is, I think, a good way to go on in this work. Then another important point, again with specific reference to the three high-risk artificial intelligence financial system, another important point is the supervision, of course. And also in respect to the supervisory purposes, the choice made by the regulation is interesting in my mind. The competent authorities for the supervision and enforcement of the financial services legislation should be designated within their respective competencies as competent authorities for the purpose of supervising the implementation of the AI Act regulation, including for market surveillance activities as regards AI systems provided or used by regulated and supervised financial institutions. This is interesting, of course. I have no time to go into details also along this line. It's interesting also underline that the last version of the AI Act specifies that market surveillance authorities should be responsible only for ex post market surveillance, because there are two different supervision, an ex ante supervision and an ex post supervision. And supervisory authorities are responsible only for ex post market surveillance activities. And also, again, in the last version, also the ECB is mentioned, and the European Central Bank is mentioned not as a new not to the ECB. The ECB is only recipient of a lot of duties of information in charge of the supervisory authorities, because many of this information could be of potential interest of European Central Bank's prudential supervisory tasks. And so European Central Bank is not involved in this supervision, but there are many obligations, many duty information in favor of the European Central Bank for in favor of the prudential supervisory activity. Up to now, only artificial intelligence high risky, but as I said in advance, the majority of AI application in the financial system are not high risky, but low risky in the perspective of this AI Act. And so the other use cases of financial AI, robo-advisor, green AI models, AI for marketplace lending activities, market abuse, and so on, appear to fall outside. I have to say that one of the last versions of the normative text, interestingly, had proposed a list of general principles to be applied to every marketed AI system in the EU. For example, encompassing principles such as social sustainability, non-exclusivity of automated decision-making. But in the final, I can say in the final version, this option was dropped. And now we can find very, very few rules directly applicable to all artificial intelligence systems. One of them is the new Article 4B. And this Article 4B is a new provision regarding AI literacy. And this provision regarding AI literacy appears to encumber any provider or user of AI systems to take into serious consideration employed automated technologies from the perspectives of the knowledge and technical risk culture involved. And this approach, it seems, echoes a requirement already present in another set of rules sectorial rules, namely DORA, in which Recital 45 lays down the notion of cyber hygiene, exactly related to technology's good governance needs, also from an educational and cultural perspective. And this reference to AI literacy could be interesting in the perspective of liability for harms determined by AI system. This is my opinion. Then a further provision that appears to apply to any AI models relates to the overarching transparency requirements under Article 52 of the AI Act for certain AI systems, especially systems who interact with natural person, with perform emotional recognition, biometric categorization, and this is interesting for financial field. I think about robo-advisor, for example, and this Article 52 is directly applicable also to these AI systems, I think. Just a final consideration on this point. It's true, the Artificial Intelligence Act is directly applicable only to few AI systems. But I think that there are a possibility because as the EBA has interestingly noticed and recently, given that financial institutions may employ same models also in the form of foundation models, these well-known general purpose AI models, for different purposes, the requirements set by the AI Act for credit scoring, credit worthiness, for example, may have a sort of spillover, a sort of gold-plating effect for the structuring of other automated credit processes as the IRB models used for capital requirement calculation. And EBA is already thinking about this possibility because, of course, if you need to be compliant to very strong rules for one kind of AI models, but in the field of credit and creditworthiness, it could be possible that that there are consequences also for other credit models. Of course, not mandatory, but this is a perspective. I go quickly. Only one reference, but because, as Filippo said, I love DORA. Yes, one of the few. Because, of course, the new rules introduced by the AI Act will be in addition to other rules already in place in the financial sector, other specific rules. And especially DORA is strictly committed in the prevention and mitigation of IT-related risks, and so also AI risks. And in this perspective, I only noticed that the market-driven approach adopted by AI Act for low AI systems is perfectly in line with the market-driven ex-ante approach adopted by DORA, because DORA entrusting financial institutions with the task of finding privately developed, thus market-driven solution to the control and minimization of a single institution's ICT risks. And so I think that DORA and AI Act could work together very well for the future. And also, I think that DORA is interesting because, as you know, the attention given by DORA to the governance and supervision of ICT-related third-party risk may be a first safeguard for addressing an important point, in my mind, quite underestimated up to now, And so the systemic risks potentially arising from AI. And this is my next point, because I think that up to now, AI Act regulation and also, of course, the other two proposals focused on AI liability are adopting a micro approach. In general, financial innovation is regulated up to now with a strong micro attention, but not enough macro attention. And I'm quite sure, I have to say, that AI is creating new sources of systemic risks. And also, I read just yesterday a very interesting post on the Oxford blog written by the Saula Omarova. And her idea is quite the same. Pay attention to systemic risk generated by AI systems, AI applications, and because you know, already in, I don't remember exactly when, but 2020, it seems to me, the European Systemic Risk Board acknowledged that technology-driven financial systemic risk or systemic cyber risk was able to create threats that require further work by macroprudential authorities. But it seems to me that up to now, this perspective is not enough underlined, and the solutions adopted are solutions maybe suited for managing micro risks, but not enough for macro risks. So this is a suggestion. So just 2 words, but really 2 words, because my time is quite finished. 2 words about the other part of the European AI package. So these 2 proposals, as I said before, these 2 proposals are related to an ex post liability dimension, because it is interesting to observe that neither the AI Act nor the DORA provide status recognition, procedural rights to seek redress, nor complaint mechanism for victims of harm caused by AI system. Really, there are a set of rules with an only ex ante approach. But it's important to manage also the hypothetical, but I think not so hypothetical, harms produced by these kind of applications and systems. And so you can find, we can find 2 proposals of directives, one more general, a revision of the Product Liability Directive, and another one more focused on AI high-risk systems. The 2 directives are interesting, of course, and are also necessary, because I think that due to the features of this kind of systems and applications, autonomous agents, opaque systems, based on a complex and very long stakeholder chain, it's very difficult to apply the general civil liability rules in this case. And so it's important to have an adaptation or specific rules focused on liability connected with AI. The work is in progress, and there are many problems, especially especially with regard to identification of the subject involved in this new set of rules. And especially, there are some problems with the category of users, also financial users, of course, of this kind of systems and application. And this is a chapter already to design, but important, because if we don't have certainty about liability and about rules applicable in case of damages produced by AI, but the problem, the uncertainty could hinder the development of this kind of new products. And of course, we can also imagine another tool, and so the insurance path, and this is a possibility. Of course, this is a possibility, and also the European Parliament suggested to adopt new form of insurance to cover this kind of risk. But I have to say that I found two EIOPA supervisory statements very, very prudent in this perspective, and in particular suggesting not to cover risks arising from systemic events also related to major cyber attacks. So I don't know if insurance path is quite easy to adopt. And so my conclusions are not true conclusions, because I think that we are in the middle of a journey, and the journey is not finished, of course. I think that the described market-driven approach to financial AI regulation could encourage financial institutions to go on in this perspective. My doubt is that maybe this framework with so many questions unanswered up to now could potentially slow down the path of the European digital financial innovation. And my final consideration is that due to the fact that also European regulation is market-driven, not for personal fundamental rights, but more in general is market-driven. Maybe under this perspective, an EU-US convergence is possible in the field of financial innovation and of financial AI more specifically, and this is my suggestion. Thank you.
Thank you, Antonella, for this great presentation that leads us to a kind of re-reasoning and reframing of these topics that sometimes tend to be too technical, but you had the capacity of framing them in a wider perspective. And by the way, since I am marketing books this morning, I anticipate that Antonella has also accepted to be an author of a commentary that Christos Gortzos, Matthias Lehmann, and I am editing on the 3 MiCA DORA DLT regulations. It's a sort of a gigantic experience. We expect to have more than 1,500 pages. We'll try to keep it short, but Antonella will touch upon this again, and she's actually taking care of large chunks of the DORA regulation that indeed deserves a lot of attention by scholars as well. It's really an intriguing and very interesting piece of legislation. So the publicity is over, and now I leave the floor to Dirk. He has a very challenging topic because he will talk about platforms, and platform is a universe really that opens up where all the topics that we discussed this morning sort of commingle and evolve in a new environment. So, but Dirk has been navigating these topics since a number of years. He is undoubtedly, among all of us, the most cited and most productive author in the field of digital finance, and I have no doubt that he will surprise us once again with his presentation. Dirk, the floor is yours.
Thank you very much, Filippo, for your kind introduction. When we selected this topic, we didn't know that actually the European legislature is actively looking into platforms, and I will show you about the recent activities at the end of my presentation, but it gave it a much more topical environment than it was actually planned, because the ESAs have written a joint report on the platforms, the stock taking. I think it was published just 2 weeks ago, so that is right now something which is kind of hot on the regulatory agenda. And this is quite interesting when you look at what research is doing. So tech risk was first discussed in 2018, 2019 as systemic risk. Today it's basically very much common domain. And so platforms, we were looking into it in 2019, 2020. And then so it's always a gap of 2-3 years until things come to the regulatory agenda. But this also shows that there's an interaction between research and policy. And I think this is a good sign. So what's the problem about platforms is that they originate in the non-financial world, but they have certain economic features which make them almost hard to beat as a competitive force in financial services as well. And when you ask yourself about the early days of the internet, I'm not sure how many people of you still know what Netscape is? Yeah, Netscape is gone. Yeah. Why is it gone? Because it was not the dominant system. And at the heart of our research is essentially the insight that we have tech-driven economies of scale and we have finance-driven economies of scale. Finance-driven economies of scale are maybe not so apparent, but they're very strong. When you don't have a large balance sheet, you cannot take on, for instance, the depository function of an investment fund as a bank. Or you cannot take on very large roles as issuers and so on that come with liability risk. So there is a kind of incentive to use very large banks for very large businesses. And we have the same kind of tendency that pushes for size on the technology side. The first copy of a software is very expensive, but the second one has almost zero cost. And these types of economies of scale eventually push for size. So there is only one dominant system in software, and when we now apply software to finance, we have exactly the same type of phenomenon. And we inquired into that phenomenon in our research, and we found that there is already quite significant market concentration in core technology platforms operated in the field of finance. What we are concerned about is that many of these tech platforms are neither regulated nor are they basically well known. How many of you know Aladdin? Aladdin? No? Never heard about it? It's the most dominant risk management system in the world. More than 10% of all asset management decisions worldwide are influenced by Aladdin. Aladdin is a risk management platform operated by BlackRock. Aladdin doesn't have a legal entity status, it's not regulated, but it's probably the most influential superpower in investment management. And these and similar things were basically at the heart of the idea. When you look into the datafication of finance, you get the third push for size. Data is a third factor that presses for size and presses for dominant platforms. And when you now think of all of this together, then we get a number of new tech-based actors in traditional finance which have enormous impact, but are entirely out of the regulatory parameter. So in this regard, we have in the last 2-3 years increasing activity on the side of regulators to kind of know what is happening. It's not necessarily about regulating them, it's just knowing what these systems are and how they operate and how they are influential. So we have on the BIS level, big fintechs is a name. We have used or coined the term tech fins for them because they're more tech-based than fin, and eventually they leverage their tech capacity into the field of finance. But the BIS doesn't like the term because it was a term used in China, and they don't like to take Chinese terms. And then the other thing is a multi-activity group. That's a European term now for this, that there are basically firms like Amazon, Google, Alibaba, active in finance. And this is basically the stock taking from the ESAs from 2022. And you will see that there are very, very big tech companies running systems which have influence on us today. I took that one because this is basically where we're coming from in the joint ESA report of January 2024, or that was just published 2 weeks ago. It's a bit more nuanced because there you will see also some more players like Orange, which is not yet here. But in the end, these are the names we're talking about when we think about multi-activity groups or mixed activity groups from the joint ESA perspective. But our starting point was essentially not so much looking at the Googles and Amazons. Ours was more what we wanted to know is to what extent technology drives concentration. And there is a famous paper of my Harvard colleague, John Coates IV, who has written about the rule of the 12. What is the rule of the 12? He means that increasingly in asset management, you see that all decisions are driven by essentially 12 large pension funds / institutional investors, including BlackRock, CalPERS, and a number of others. And that, of course, undermines traditional corporate governance theory because in the end, you don't have diversified investors anymore. You have a strong concentration of maybe 12 control holders, and that is maybe against everything that we speak about, whatever agency cost and so on, because these are not controlling on a single and individual basis, but they often vote together. They have maybe the same proxy advisor. They're all kinds of coordinating institutions that make it essentially a kind of powerhouse. And this rule of the 12 was just discussed, but no one ever asked, why do these 12 are only 12? And the reason is technology. This is our answer, and I will make this case now into the next 20 minutes or so that I have. So what's the point here? The point is that these digital finance platforms have a much stronger role, and because I have a strong research focus on asset management, I was particularly interested in asset management because there I knew most about it. And then I came across Aladdin. And Aladdin is basically the first fintech. It dates back to the 1990s. It originates in a kind of need of the US government to restructuring housing loans. And they were kind of asking BlackRock for advice, and BlackRock wrote a kind of algorithm that undertook the task, and that's the birth of Aladdin. And Aladdin holds so much assets, or basically it influences so many asset management decisions, that it exceeds the US total stock market capitalization, and you know that's the largest financial market in the world. And it has 55,000 investment professionals relying on it. What is Aladdin essentially doing? It is controlling the data. They're gathering data from all kinds of sources and provide different type of models that you can rely on, or you can use your own model, but it's basically a data aggregator. And you have basically in this type of data aggregation system now the opportunity as asset manager like Schroders and others to use one single database for every event in the world. Every financial event is listed in that database. And that, of course, is extremely powerful because you forego the need to collect the data, and you have a lot of analytical tools that you can use to tap into this giant data pool. And so when you want to, for instance, calculate a certain forecast, there's no better database than what Aladdin provides. So all kinds of risk assumptions can be modeled. You can use your own risk management systems, but you can also use the ones that Aladdin provides. And when you think about Aladdin, Aladdin is something on the back end, and that's why you don't know it. But we also saw a lot of front-end developments that are going towards there. When you are looking at Fidelity, Vanguard, Schwab, the very large ones, but also Goldman, Morgan, what they try to do is they build tech platforms up front for many businesses that they don't offer themselves. So they want to be the contact point for every financial decision that you're taking. And from there on, they're channeling the business somewhere else. And you ask yourself, why in the world do you want to do that? You would think about liability and so on. But the reason is they get control over the financial streams that these type of contacts mean. Today, of course, when we look at the respective EU Data Act, we know that there are gatekeepers, and the gatekeeper function is they channel the business where it is useful for them to a certain extent. Of course, you have choices, but the key choice that you have is go via that platform, and then there are links built to that. And when you look at the pure size, you kind of get crazy when you see that these are, in the case of Fidelity, more than 40 million clients. I'm not aware of any European institution that has that many clients. Yeah? And this is, of course, a kind of gatekeeper function in finance, which has here led to significant market concentration. And that also explains why we see zero-fee funds. Zero-fee financial products don't make any sense, correct? But the way is that you get, as a platform provider, the chance to trade in the business for other type of benefits. Usually you would think about commission, kickbacks, everything like that, but the kind of kickbacks they get is more implicit. Well, paying for order flows and anything like that is coming up. We know that, for instance, some fintechs try to build the same. They have only 5-6 million clients, but they also trading in basically client business, like Citadel and similar firms are kind of using that based on the tech businesses that they are working with. So why is it? So this is a liquidity side. So we have the data side in the case of Aladdin. We have the liquidity side in the case of these front-end platforms. And then you would think the best of both worlds is having the financial side and the data side, correct? And for that, we need to go into China, because there's the largest financial operating company in the world. That's Ant Group. Ant Group is not large in terms of its balance sheet, but in terms of its clients. They have more than 1.4 billion clients. 1.4 billion clients. When you take the adult population of the world, they're serving about a third of the adult population of the world. One single company. And that's maybe the reason why they eventually were not allowed to be public, and they were put into a kind of conglomerate-style regulation by the People Bank of China. And so this was not really expropriation of private property. It was something that we as regulator would have necessarily to do. Otherwise, you have a very strong systemic risk that simply comes from the malfunction of Ant Financial for the Chinese market. So for me, it was a very sensible thing to do to increase oversight over Ant. But the interesting aspect is that Ant is not only a payments operator. It is also basically looking at a number of other businesses. When you, for instance, look at it, they run the largest money market fund in the world. They have an insurance business with an astonishing number of clients. They have all regulated fund managers accessible only through Ant, which is a monopoly, another gatekeeper function. And of course, insurance. 400 million clients in insurance is a wonderful risk pool. Means you can do your own risk business very well, because you have this immense pool of diversification inside the Chinese population that you serve here. So you see that market concentration has some appeal, and it comes from the fact that they have both the data control, because they merge the data from Alibaba with the financial data, together with the liquidity control that comes with the financial flows. And that is basically the power of data and finance, which I mentioned in the beginning. And of course, when you look at the setup of these type of firms, they are linking services which are not their own services. And of course, when they know that the linked service is profitable, they can build it themselves and offer it. And that's a bit the Microsoft idea. Why Netscape was vanishing was because there was a more dominant browser system that was developed and then pre-automated on your Windows system. Netscape was gone in seconds. And this is exactly what we have here in finance. So the largest competitor of the linked service is the gatekeeper through which it is accessed, and that is, of course, a major problem for us today. Well, of course, much of what we see here has tremendous benefits, because the size effects also means that the transaction costs related to technology are very low when you have this very large client base. On the other hand, you can provide a large service, a very good service level, yeah, because the respective platforms are multifunctional. Everyone wants to be linked to them, so they have a bundling capacity in this effect. But of course, there is also a number of risks coming from the client protection side. Yeah? So they're bearing tech risk without being aware of it because they think they are contracting with a financial institution. But in the end, it's a large tech provider, and so there's something about this lack of transparency. And of course, also the regulators have a problem because the respective financial institution is regulated as a financial institution and not as a tech conglomerate, and that means the respective tech risk parts are probably underemphasized, and the financial regulatory parts, capital adequacy and so on, is all based on the financial transaction, which is only a very thin, a very small part of the overall meaning of these firms. Of course, national security is increasingly a concern when you think about size. Yeah? I'm always joking that the North Koreans would be very interested in many of the transactions that take place in Luxembourg because they give power, but we can replace North Korea with any other type of superpower, including our friends in the West. So that there is, of course, a concern about sovereignty. And when you run these many platforms, it also means that you run the data of a lot of people. You basically control their life. And this is an aspect that we have also now increasingly in the AI, but also in other tech-driven aspects. So, well, the problem about this is no one wanted Ant to become that big, but it just got big because of these very fast developments from a very small kind of entrepreneurial idea to a financial powerhouse, which in many respects is today the largest financial institution in the world. And of course, this immense speed is what it makes it special, because these type of links of the financial and the technology-driven economies of scale create these type of firms. So tech risk was discussed. I will make it short because there is, of course, tech risk in it, quite immense on the micro level, but also on the macro level. In particular, when you have these institutions on a large scale, it is a systemic risk, but it's also a simple life management risk, because when, for instance, Ant is down, the whole Chinese economy will stop, yeah? Because there are no ways to make payments anymore. That means when 70% of one kind of population is in the hands of one payment platform, and the payment platform is down, the economy is suffering. That's not just a financial shock, it's a real world economic shock. And it also leads to frenziness on the side of the people, so that will lead to a lot of political upheaval, which is something that I don't want to dream about. So I believe in diversification in terms of providers here. And of course, when we think about it, all of these type of things are very difficult to challenge once you have reached that size, because of the immense complexity. The immense complexity, the linkages between the financial side and the non-financial side are quite intense, and that creates a new type of regulatory challenge. Of course, I spoke already about the market concentration aspects, and why it's also difficult to challenge them by way of regulation is because technology as such is not the regulated activity, but other ones. And when you think about our definition of the financial holding company, you will see that the entities I've shown at the beginning of my presentation are primarily out of reach, because financial holding, the FICOT regime that we have, is oriented towards banking and investment firms primarily, and maybe also to a certain extent insurance company, but many of these services are basically below the regulatory radar and don't trigger FICOT supervision in the current place. What can we do? Well, to a certain extent, we can try to support competition. And here, mandatory access rules seem to be a great idea. And here we need to lean on our antitrust law, which is quite helpful in terms of mandating access. Then we have, of course, the EU Data Act, which has also for gatekeepers a certain mandating access regime. We could think about asking for rotation, but that's probably not a good idea, because these interfaces are extremely costly to program on the side of the offering firms, so that will be a lot of disruption going on. I believe in open data. I believe that our both GDPR and the PSD2 has a certain starting point for open data, and in particular when based on a consent requirement, you can move with your whole history to someone else, and the old provider has to delete it. That may be a certain point, but on the other hand, we shouldn't be too blind to the insight that the best person who can integrate all this data is a platform. That means probably open data, and this is exactly what we saw in other markets as well. Probably open data will primarily lead to even further concentration because you can faster get the respective data. So while I'm believing open data is a good idea, we need to ask the question, where's the data migrating if we impose open data requirements? And that's something that is probably not so easy to regulate. Then we do something which I will promise later, which makes sense. Unbundling of services and fees, I think, is extremely crucial, that you give separate prices so that it doesn't look always as a bundle of services that you cannot price separately. And that's probably one of the things we should do. Moderate interventions. Well, self-regulation is probably not a good idea because the one person dominating self-regulation will be the dominant platform. But I'm thinking what we can do is looking into things with something that I call financial data gathering regulation. What do I do there? I develop a kind of rule which says financial data gathering is a regulated activity. And then I use enormous large carve-outs, similar to the ones that we have in the EU Data Act. When you look at that, that's 7.5 billion turnover and 45 million clients. Similar, very large thresholds for that type of activity could lead to a better insight of regulators. And the type of regulation they would do would be just reporting, because what we want to know is where the linkages are. The tech risk management is something that we want to know about. And I'm thinking this is something that we can try to do, but let's not be too illusionary about the effect. Of course, the type of information that we will get is never 100% accurate, because there's a regulatory time lag, and we need to ask whether the financial regulator has the tech resources to assess in a meaningful way the complexity of information they get here. I'm thinking DORA's indirect regulation approach is not a too bad idea, because we say crucial providers are to be taken into account in the risk management. But that's a bit a problem here, of course, that the tail is waggling with the dog. Just to give you an idea, all the firms that I told you there have an enormous market capitalization and could buy Deutsche Bank tomorrow out of their cash. They don't even need to go to any bank. The cash reserves of all these firms is so large that the clients are dwarfs. And that also is important, the client relationship, because they can forego any of these clients when they try to push pressure on them. And so it's all the more important that there is some type of regulatory support, because on a market basis you will not get the respective information. So there must be a kind of support from the regulators of a standard set of information that is exchanged so that it can be considered. And in this regard, I like to give you a certain piece of information about the Luxembourg law. Luxembourg, we're kind of aware of that. And you need to think of Luxembourg with 15,000 investment funds. We have a lot of these tech platforms underlying the business, and they introduced quite a long time ago, 20 years ago already, PFS law. That is basically professional and financial services. Professional and financial services is basically everyone. If you're not regulated by other ways, everyone must be licensed under the professional financial service law. And that's basically just a fitness and properness regime that asks you to register. So people know who you are, where your addresses are, and when they don't want you, because you have maybe a bad history, you're kind of forced to leave the market. And I like this approach because it's very light touch, but it brings some information into it and gives the CSSF the power to basically make sure that certain people have to leave the market, but also that certain people can only play on the market when they're transparent about their activity, ownership, and so on. And so this way is basically the response of a financial center, which has learned the hard way that the crooks and the thieves are always present, because it's always better to live on someone else's money than your own. So in financial centers, you need to be very aware of this risk. And for that reason, this is a kind of gatekeeper law that we have there. So In this regard, let's have a quick look in my last minute that I have for you on what's going on the EU level. We have here this call of advice. There's a study commissioned by the European Commission going on right now. I'm involved in that, so I cannot speak about it. And we have probably in 2025 the decision what to do. Do we need something to do in light of what we already have? Because we have DORA, we have the Digital Markets Act. That's definitely something where we should think about to what extent we already cover them. The thresholds for presumed gatekeepers is too high, but maybe we can have a sectorial definition of gatekeeper. We should think about what in this regard, this type of quadruple that we have here, the impact on structure, the finance, the strategy, and the technology makes to the respective financial sector, and not only look at finance at large, but maybe payments separately, asset management separately, traditional lending separately, yeah? Because only then you see these niche providers. As I said, Aladdin is a risk management system for asset management, and this is extremely dominant, and no one knows about it. So, and of course, the risks are enormous, and so to a certain extent, it's foreseeable that we need to get transparency in what's going on. That doesn't necessarily mean that at the same time we want to regulate them to kill them. Yeah? That's not what we will probably never be able to do, because you cannot run against markets, but it is basically something that will require intense cooperation among the regulators in the future to have a better view on where the risk sources are and what the potential remedies are. With that, I'm at the end. Data and liquidity drive concentration in finance. It is already present. It's not something that goes on in the future. We have a bit of a problem here, because the traditional regulatory objectives, investor protection and so on, they would already justify to interfere, but we have a kind of new regulatory objective, which is market structure. Competition is basically, this is actually competition law in finance. But to a certain extent, when you think about it, competition is also the underlying rationale of investor protection, of systemic risk, of many other elements in our financial law. And so from that perspective, I believe that the main thing that we should think about is transparency, enhancing transparency by way of regulation. With that, I'm in the end. I just say the People Bank of China did exactly that. They asked Aladdin and finance, in this case, to put all their data in a public data warehouse. I think this is something to think about. It's basically a new type of market infrastructure regulation, that the access to data is ensured by public regulatory oversight. And that may be a trend that we should think about. Of course, it only makes sense when you have structured data, so that whatever insolvency administrator or financial regulator can make use of them. But it's an interesting movement of the first regulator that we're facing an increasing concentration in the market that we've never seen before. And since it seems to be the norm that we all market our products, I will be no exception here. And we already wrote about market concentration and challenges in finance in our FinTech book. Thank you very much.
Thank you, Dirk. I think we made the right choice to have your speech at the end, because it sort of brings a lot of stuff in a single box. And now we do have a few minutes for Q&As, interventions, if anyone would like to take the floor. There's been a lot of stuff this morning. We've been really touching different topics. There's one question there. Raffaele.
Thank you very much. Hello? Yeah, okay. Thank you very much. My name is Patrick Hess from the European Central Bank. I'm also teaching here at this university. What you said about this money market fund, I think it's still the largest in China, but no longer in the world. Do you think it was the right response by the Chinese regulators? Because this was approximately the time 2017 when EBI led the global league tables, that the regulators intervened, and then the size of the fund came down, and it's still the largest in China, but because of this huge dominance they had in the market. And the fund, just to explain, works like that. It was basically the payment account, Alipay, which was then automatically transferring the balances to this fund where, let's say, you got interest and much more than, of course, with a normal current account with the banks, and probably also more than a savings account. So do you think it was the right regulatory response?
Dirk, yes, I think you.
Okay. Yeah, thank you. Yeah, this was, of course, a very clever tech feature, which always works when you have very small amounts. Then you need to bring down transaction costs to almost zero. And then very small amounts put together bring enormous large numbers. Yeah? So there was a discussion whether this qualifies as money market fund, of course, yeah, for that reason, because usually you would say you have a bit of a different technical definition, but it operated then as lender. So this was the interesting side, yeah, so of it. So I asked myself, was it possible in Europe in the same way? Yeah? And we have money market fund regulation in place. So from that perspective, probably it was only possible because there was a lack of regulation on the Chinese side. We know China as an industrial powerhouse, but in terms of regulation, it's to a large extent underdeveloped. And in particular, in this niche parts, there was an entire lack of regulation. And so it was for them, for the regulator, it was a kind of shockwave that overnight, when this tech feature kicked in, they had these $250 billion US. So this was the thing, yeah. And this is basically this type of fast-changing environment is something where, of course, activity is necessary. Was it the right response? Well, the right response is to have proper regulation in place, so things like that don't happen. You should not be surprised as a regulator. And this is very much touching upon something that we had yesterday. The point about financial regulation is that we have all these boxes. And in these between the boxes, when you start pushing at them, there's always space. And these tech providers go for the space. They exactly go for the space. This is what they want to do. The niches in between the things. So as long as we write regulation that has air in between, these things will always happen. I think it was a typical Chinese response, let's say it that way. The same way when rather than to stop the IPO and announce they should be subject to FICOT, the key shareholder just vanishes for months. That's also a Chinese way of doing things. And the important part, what the People Bank of China told me at some FSB meeting where I was present, he just told me, no, when we disapprove things, we don't need regulation. Yeah, and I'm thinking in a law and order environment like in Europe, we would need to think more clearly about FICOT, expanding FICOT to a certain extent. This is, I think, one of my gut responses because it would give us access to the data. I don't think capital adequacy works well, yeah, because these firms have no issue to meet any capital adequacy rule. I'm a bit concerned that they eat the lunch of the banks. That's my concern. They take the profitable business out of the banks and leave the risky business with the pools that operate as banks. And that's my concern because there's a reason for banking regulation in the end. Yeah? We don't want the banks only to be bad banks. We want them to be active and profitable. And the best and most stable bank is a profitable bank. And for that reason, I like to have competition at the same terms. That's, I think, the key concern. And at the same time, I like the tech side of it because it's a fantastic service tool.
Good. Raffaele?
Raffaele D'Ambrosio from Legal Department of Banca d'Italia. So I have an issue regarding the EBA powers under the MiCA regulation, which Despina is already aware of my concern because we already talked about this topic several times. And the point is the following. We know that under the Meroni prohibition, because of the Meroni prohibition, the EBA power are very well detailed in the MiCA regulation. But this notwithstanding, and however numerous and specified this power may be, there is nothing, or more or less nothing, under Article 130, if I remember well, of the MiCA regulation, that could be compared to the Pillar 2 powers under CRD. So there is something a little bit comparable to this, the power of the EBA to ask the issuer to limit the amount of asset-related or e-money token issued, but nothing more. So how would it be possible a supervision, a prudential supervision on those issuers without having a complete set of Pillar 2 power or something comparable to those powers? And if you agree, is there any reason behind or not of this choice of the EU legislator on Article 130 of the MiCA regulation? This is my...
Thank you, Raffaella. I think actually what you said explained in more words what I was mentioning as a challenge, the Meroni challenge to what we can do. So I haven't studied the details yet to give you a specific answer on what other legal basis there could be, but I agree that this is exactly the challenge that I was referring to, and I cannot say too much about this, but also internally, you know, there our experience as EBAs in the prudential area, and one of our directors in one of the steering committees about MiCA was raising one such question of the Pillar 2. We are used to, in the banking world, having these powers, and how is this going to work? The reasoning, I think, is purely Meroni, I think. I'm not the one who drafted it, but I would explain it like that. And what are the ways around it? I will go back to what I was saying. I think some of you who know me know that I did my thesis on the Lamfalussy process, so maybe you think because I'm holding a hammer, I see nails everywhere. But I honestly think that in this case, this is the true solution in many ways. Also in AI, in DORA, it's our role as a hub and spoke of the competent authorities, of those who actually supervise, also the supervised entities that will come to us. So you saw also under MiCA, there is no authorization by EBA. Authorization is firstly done by the competent authorities and then passes over to us. So I think that's where the solution might lie, because in the colleges of supervisors, we might find different approaches, the cooperation. Maybe we have to rely on some aspects of the competent authorities to take some roles on them where the legal bases are. Again, these are all border issues. Rosa, in her other articles, she was speaking about the border number 3. And so this is, we are always in the border. So I'm probably not giving you a satisfactory answer, but it's a work in progress too. At least that's how I see it.
Okay, thank you. We have space for a couple of short questions, but then we also have the coffee break and we can continue discussing during the coffee break. Maybe Iris, you were waiting for some time.
Thank you so much. Iris Barsan, Université Paris-Créteil. So I have one question for Dirk and perhaps an observation. Perhaps I didn't get your point sufficiently well, but in my opinion, what you're pointing out, I'm wondering at least, if DORA doesn't catch actually these platforms, because you have the supervision of critical third-party service providers now under DORA, right? That is, they will be subject to regulation. And the second point is that the financial institutions need now to focus on the concentration risk in tech. So I'm wondering how this is going to affect what you were saying. And my observation is that with regards to competition, what you pointed out, we need more and more transversal competences. And I'm wondering if the GDPR, and with the decision of the European Court of Justice on meta platforms, right, that actually said that a competition authority can sanction with regards to competition law if you don't comply with the GDPR, becomes an enabler for other pieces of legislation. So if this doesn't allow to put a little bit a lid on it.
Yeah, thanks, Iris. Yeah, DORA is one potential response, but it works much better if we know what to do. Yeah? And of course, the point is a lack of transparency. For that reason, I started out to ask you about Aladdin. Yeah? This is a group of finance experts and no one held up the hand. Yeah? The lack of transparency. If I know everything, I could do it. But the cases I've discussed are the cases that are so obvious and no one has seen them coming. And so in this regard, I believe that our financial conglomerate regulation is outdated. Yeah? It doesn't cover large parts of finance today. And we lack very often the information on it. What DORA may help to a certain extent is in particular when you have the DORA reports and they're submitted to the NCAs, and then maybe there is something like a risk tableau that some of them will be named crucial third-party providers in the end. Yeah? But in the end is a long time from now. That's just something. And they are probably not that mega large right now, but they may increasingly become a concern also in the future. Yeah? Of course, the ones, when you look on them right now, like Google and so on, they're already on the radar. Yeah? But there are many more. And of course, DORA is a different situation than what we see in the case of the mixed activity groups. Because here, the business comes from the gatekeeper and goes to the financial services. Yeah? So basically, the Aladdin situation may be covered by DORA. The other one may be covered by the Digital Markets Act. But this is exactly something where we need to ensure that the financial regulators, which are not in charge of the Digital Markets Act, have the information of relevance that comes from the Digital Markets Act.
Okay, thank you. Maybe I would suggest, because we're running late, to continue the discussion during the coffee break. I'm sure that all our panelists are available to discuss further, but I don't want to eat up additional time for the other panels. So thank you, everybody, and see you in a couple of minutes.